A 13% yield. What could go wrong? Ooh, we're going to dive into this from Morningstar, and then we're going to show you the second part. There's not much to like when it comes to structured notes, says Amy Arnott. Is she married to Rob? Let's take a look who Amy is. She's CFA. Let's see here. Is she married to Rob Arnott? Let's take a look. And does not own any shares. Okay, so hold on a second. Let me tell. I looked. Amy Arnott, a CFA, Rob Arnott, in the same business. They got to be married, but who knows? All right, so one of the fundamental truths about investing is there's no such thing as a free lunch. An investment that promises higher returns is going to come with a higher risk of losing money. And often, those bigger return promises not only come with greater risk, but a lot more complexity and higher fees. All right. That is certainly the case for securities known as structured notes, so Amy's not a fan. Investments that some financial advisors have been pitching to clients with growing frequency. In a recent in-depth report on structured notes called Structured Notes, Buyer Beware, my colleague and I found we didn't like it when it comes to these investments. In this article, we help aim to answer the question, should I invest in structured notes? All right. Structured notes are basically stock bond hybrid with a limited lifespan or maturity. When an investor touts them and an advisor touts them, they may sound appealing because they combine high coupon rates with some level of principal protection. Like bonds, these securities typically make regular coupon payments and are set up to repay principal at maturity. So far, so good. Legally, they're unsecured debt obligations of the issuing bank, typically large investment banks like HSBC, JP Morgan. That's why all the big banks did them. And I remember when I worked at Smith Barney, it was part of Citigroup, and we issued these like crazy because it's like she said, unsecured debt obligation that the bank guarantees. Some are actually even FDIC. It's crazy. Structured notes took a serious reputational hit in the wake of the GFC, global financial crisis, when investors holding notes issued by Lehman Brothers nearly lost all their original investment. There you go. So if they weren't FDIC insured, just backed by a bank, yeah, you got smashed. They can be set up in myriad ways. Issuers basically mix and match the key product attributes to meet demand with hundreds of different structures. The complex design of structured note often makes it tough for investors to understand what they're getting. All right. Importantly, unlike most bonds, the coupon payments are often contingent on the performance of an underlying asset. In contrast to stocks, whose gains are potentially unlimited, structured notes have no potential to appreciate in price and have an explicit cap on the upside. All right, so far, so good. We're saying basically at the end of the day, you're going to get a bond-like coupon much, much higher than a bond because there's significant more risk in it. But unlike a stock, you're not going to find you don't have unlimited upside. And a lot of these structured notes will guarantee your downside by the issuer. In this case, if Lehman Brothers is the issuer and they go bankrupt, you're SOL. That's a pretty unlikely event to happen, but it did in our lifetime. So just keep that in mind. All right, here's an example of how an enticing yield belies the inner workings of a structured note. Linked to this price of an oil and gas company called Diamondback Energy, FANG. Is Diamondback Energy really called FANG? Officially called a contingent coupon note, the security was issued in January of last year, 2020, by Barclays. It had 2-year maturity and offered a tempting yield of 13% annualized, though a quarterly coupon of $32 through a quarterly coupon of $32.50 per $1,000 in principal. The note's all payments were based on the FANG stock price. The key for buyers of the note is that will only pay that quarterly coupon if FANG shares are trading at or above a predefined level, defined as 70% of the initial share price. Let's see. If the stock drops below that, investors don't receive a coupon for the quarter. All right, so you'll get that coupon if FANG shares are trading at or above a predefined level of 70%. So if it drops 35% in value, you don't get anything, if that makes sense. If it drops 25% in value, you get that 13% coupon. Based on past performance, this probably seemed like a fairly safe bet in January. As a prospectus date in January, FANG had been above the coupon barrier of 64.58 for most of the previous 5 years. And while the stock was volatile, as are many energy companies, even a repeat of FANG's biggest calendar year loss of 26% in 2018 would have still left shareholders above the 30% decline that would have halted the coupon. Then there came the historic drop in oil prices following the onset of the coronavirus, and it plunged more than 70% in the first quarter. And so it's still on the observation date, in the first quarterly observation date, it was still well below the 64.58 share coupon. That meant investors didn't receive a coupon for the quarter. The note still has about 18 left to maturity, but if it remains below the coupon barrier, investors will miss out on additional coupon payments. All right, well, I mean, all right, so the note still has about 18 months left until maturity, but if it remains below the coupon barrier on future quarterly observation dates, investors will miss out on additional coupon. All right, so that's a risk to get 13%. That doesn't seem that big of a deal. If you're disappointed by missed interest payment, you don't have much recourse because they aren't traded on exchange, so you're not going to be able to sell. You just got to wait for maturity. Investors who continue to hold the notes face some additional uncertainty. For one, issuing banks can force the notes to be redeemed prior to maturity after end 6 months in a 6-month period. If notes are called prior to maturity, investors receive their principal back plus a contingent coupon. All right, in this case, Barclays has sole discretion to decide whether to call the notes on a specific call evaluation date starting in July 2020. Investors have no way to know when the note's actual lifespan. Traditional bonds promise to pay back buyers 100% of their initial investment. That will also be the case for a structured note, but only if the stock or underlying benchmark doesn't close below its barrier value at the time the note matures. Okay, so this is what I want to know. If FANG remains below the 64.58 barrier at maturity, you will take a loss in proportion to FANG's stock performance price at the life of the note. Okay, gotcha. So that's the key thing. So not only do you not get the coupon, but if it remains below 64.58, you will also be taking the loss as well. All right, well, that's interesting. Granted, the FANG note could be viewed as an extreme example of what could go wrong with structured notes. Well, it is because it's one stock. Actually, when was this written? Because let's take a look here. June 2nd, 2020. So let's take a look at FANG. Let's see what FANG's doing now. What's that? $80 there? What's this lady's name? Amy. All right, so it's at $80, man. So it's above the 64.58 threshold, and it's down 34%. I'm not sure. I guess from July of 2018, but 35% or 30%, but still, it's at $80. So it is back beyond its threshold. So you're back in the money on this. All right. So, all right. I mean, let's keep going here. All right. So quite simply, it's hard to think of another example where investors would voluntarily purchase something that promised to give them the worst of multiple outcomes. And she's saying if the FANG isn't complicated enough, a popular variation is notes where returns are tied to more than one index or underlying security. I don't get it, man. So this was issued in January of 2020. Valuation date starting July 2020 is a 2-year thing. So not only are you going to, I don't know if you're going to get the coupon. I don't know if you get the appreciation. I have no idea. But do you get the appreciation? So let's see here. So importantly, like most ones, I guess you don't. Let's see. Okay, here's an example. This security has 2-year maturity, tempting annualized yield of 13% through a quarterly coupon payment. All right. I don't know if she doesn't say if you get the downside, you also get the upside. I bet you. I don't know how you could. Right, but I don't know, man. I mean, so here you don't get the 13% coupon in April of last year. Well, no one did, man. And but now you're back up above par, so now you're getting the coupon, and on top of that, you're getting you'll get your money back too. All right, a lot of hidden costs. Structured notes are typically sold by brokers who receive commissions averaging about 2%. Investors don't pay these fees directly; they're built into principal value. Yeah, I mean, it's nothing for free. Conclusion: structured notes. Let's see. All right, yeah, you're paying commissions. There's no other way around. On average, the issuer reported fair value is about 97% of the value investors paid, so that translates into an average markup of about 2.9%. Conclusion: structured notes may offer big payouts, but those advertised yields aren't always worth the risk. In fact, when we recently dug into some of the academic research and how they performed, we found that 2 of the 3 studies we reviewed found on average structured notes have failed to perform better than a balanced portfolio of stocks or bonds, and at times have failed to keep up with the risk-free treasury bills. Structured notes still account for a tiny fraction of investable assets in the U.S., but they've been gaining popularity among recent volatility. All right. So here's my take on this. If you're buying a structured note, you're not buying it. You're not buying it to compare to a stock versus bond. You're buying it for downside risk protection. So you want to make sure it's unequivocally no downside risk. So I would not buy it if there's a floor that if it goes below that floor, you get skunked, because that defeats the whole purpose. In this case, the FANG one, if it fell 30%, you're on the hook for losses after that. Well, that's not what we're trying to accomplish here. We're trying to minimize downside risk, giving ourselves upside limits, I grant you, but it's only a 2-year freaking commitment. And that's not a good article to hammer structured notes. I mean, it's good back then, but it just goes to show you, fast forward a year. Is Amy writing about this again? Let's take a look. Let's see if she wrote about structured notes again. I bet she did not. I mean, this is the drive-by media that Rush Limbaugh used to talk about. Yeah, we're going to report on something in the worst possible scenario, and then we're going to run away. And now that's back up, and you're never going to hear about it again from us because it doesn't make us look good. All right. Does factor profile diversification work? Charity kid, should you diversify factor? Yeah, notice that she's not talking about structured notes. Let's see. Thematic. Why should you care about inflation? Problem with optimizers. I'm lukewarm. The real estate. Will the real retirement number please stand up? Yeah, it's weird how she doesn't talk about structured notes, isn't it? So what happened, man? And it's been a year now, and you haven't revisited this. Why not, Amy? Yeah, that's weak sauce there, if you ask me. If you're going to bag on it during the downside, you got to bag on it when it comes up again, and she's not doing that. Anyway, if I'm buying a structured note, I want to make sure it has a guarantee that I'm not losing money. All right, now I'm willing to sacrifice upside. So I'll say, look, as long as it's guaranteed, I'll take a 5% guarantee, 5% rate of return, or nothing. I don't want to lose. 0 to 5%, I'll take that for short term if I'm worried about the market. That seems absolutely ideal to me. So anyway, weak sauce, but I'd love to hear your comments. We'll see you.